Let's bring in today's market panel. We got Dan Henninger from the Wall Street Journal, Adam Lashinsky from Fortune. They are both Fox News contributors, and Lenore Hawkins from Tematica Research. Dan, you and I were together at the Wall Street Journal back in '87 in October when that 22% crash happened. In a couple of weeks, we were back to normal. It tells you what happens when the market crashes without a recession in place. If the market is crashing because of the overall economy, you're in trouble. It's probably going to stay down for a long time. If it crashes in a healthy economy, it's likely to bounce back pretty quickly, no?
Yeah, I think that's right, David. I mean, unless all of us are missing something, there's really nothing out there in the world right now to suggest that what's been happening in the economy is threatened in any way. The real economy is very strong. For instance, the ISM, the non-manufacturing index that came out today, hit 59.9. That is really high. The estimate was to be 57.6. So just another indication that the real economy is going well. I think what happened today is basically that the stock markets are going to sync with the real economy, getting in sync with the real economy. And that necessitated some kind of pullback to the point where the two of them could start operating on the basis of something real, more real than what the stock markets have been doing recently.
Well, Lenore, are we missing something? Is there something big, a subprime mortgage crisis, something that we aren't seeing right now?
Well, one of the things I think we haven't been seeing is that, yes, people have been talking about how this has been one of the most expensive markets and that stock prices are really priced for perfection and then some. But what we're not seeing is a lot of talk about just how the U.S. is performing relative to the rest of the world. Yes, our economy is doing well, but out of the top 29 countries, we're only 10th for economic growth. And if you add in the impact of a falling dollar, because the dollar's down about 12% since the presidential election, you put those two together, our markets are less attractive for international investors. So money's going out of the dollar, and it's also going out of stocks.
Well, Adam, is the market afraid of the Fed? I know for years the market was afraid of what the Fed was going to be doing when the underlying economy wasn't as strong as it is right now. But is there fear about the Fed raising interest rates? Because we know there are a lot of bonds on the market. The only way they're going to sell all these bonds is by raising rates, right?
Obviously, there's fear, but there was fear last week and the week before that, and last month for that matter. There's been fear for quite some time, so I don't think that would explain today. Neither do I think Dan's comment that the market is coming into alignment with the economy. The economy doesn't move in big herky-jerky moves, and so if the market were coming into alignment with it, it wouldn't do it in a herky-jerky. Well, the economy doesn't move that way.
Although, let me challenge that and go back to Dan, because I think one of the things that set off this pattern was that forecast from the Atlanta Fed when they said they thought first quarter growth could be 5.4% GDP. That is a herky-jerky motion on the economy if that's real, and it makes people nervous about inflation, about all kinds of things, Dan.
Yeah, and indeed the Fed. I mean, the Fed has kept interest rates so low for so long. They're now talking about the possibility, I think, of 4 interest rate increases in the coming year. And that's going to have some effect on markets. There's no question about it. So I think that those are the realities that are going to cause a sell-off like this and get the market back to the point where they can react normally to what's going on in the real economy. And I would suspect once we hit this leveled off point that the market will again begin to start growing, as some of the people on Fox have been suggesting, but not at the pace at which it's been growing here recently.
Lenore, let me ask you a little bit more about the Fed, because we're not just talking about interest rates here. We're talking about the balance sheet and the tapering effect and the idea that, I mean, they picked up a whole lot of product along the way in the past 8 years, stabilizing the economy. At some point, they have to clean off that balance sheet. I don't think it's a coincidence that Jerome Powell was sworn in today, the new Fed chief. Couldn't a lot of this nervousness be about that?
Absolutely. And let's not forget that we're now in a level of deficit spending that you normally see when the economy is not doing well. We actually had the biggest deficit last year in 2017 that we've had since 2010. So while we're hearing the economy is doing great, unemployment's at record lows, we have a ballooning deficit. And what that means is more debt has to get issued. So you have the Fed raising rates, you have the Fed tapering, and you have the federal government issuing more and more debt. That's going to have an impact on rates.
Go ahead, Adam. I hear you itching to get in there.
Well, I was itching to get in, and I had a cough, which was completely unrelated. I wanted to be clear about
Well-timed cough.
But honest. But Melissa, I did chuckle at what you said. I think it is literally a coincidence that Jerome Powell's first day at the Fed was today. It has absolutely nothing to do with that. And all of the very accurate and fine comments that Lenore was making also were completely apparent last week. So, I mean, we all want to explain this, but sometimes things are inexplicable.
I don't know. I'm not sure it's inexplicable. I mean, this one isn't as much of a head scratcher, Dan. We have a market that has gone up and up and up. And I have talked to a number of people who said they love it. They don't necessarily believe in it. It feels too frothy. We need a bit of a correction. Is that what we're seeing, Dan?
I think that's what it comes down to, Melissa. This is a correction. As somebody once famously said, markets fluctuate, and they haven't fluctuated much recently.
No, they haven't. They've just gone straight up.
So it had to come down, and as David was suggesting, 1,600 points is not the same as 800 points in 1987.
Okay, terrific, guys. Stick around. Don't move.